Thank you for joining us for our mid-year economic update. My name is Dave Mantell. I'm the managing partner of Stabler Wealth Management. Although we're getting to the end of summer, we'll still call it our mid-year economic update. And there's a lot of information to unpack from the first half of the year. So looking forward to jumping in and trying to provide some perspective and outlook of the current market and economic environment. So with the mid-year 2025 economic update, it has been a year of volatility and uncertainty so far. Fortunately, at this point, we've experienced a very solid market, but it hasn't felt that way going along. And looking ahead, there's no shortage of headlines, new information, uncertainty that will likely keep the rest of the year eventful as well, is one way to put it. The purpose for these economic updates is knowledge rather than just power is empowerment in our view. It is very easy to feel anxiety from the various headlines and things happening in the world. And so the more you could provide some perspective and understanding of the underlying inner workings, as well as how clients' portfolios are positioned to handle that, results in less stress, sticking to the plan, better outcomes. And so these are things that we like to continue to provide information on, perspective, because we found it goes a long way to feeling not only more comfortable, but sticking to those well-devised plans that we lay out. So as we take a look at the second quarter stock market performance here of the Dow Jones and S&P 500 index, if you had gone to a tropical island with no internet or cell phone, and you hadn't looked at a newspaper and you had no idea what was going on the past quarter, you look at this and say, wow, what a great quarter. The S&P 500 was up double digits, over 10%. The Dow was up a solid 5% for the quarter. And so standalone, we saw a really strong second quarter of the year. When you look under the hood a bit deeper, the experience was very different in anything other than low key and smooth. Whereas you can see highlighted here, in April, we went through a historic drop in the markets in the first week of April after we had the rollout of the new tariff plan that occurred with Liberation Day, where basically President Trump pulled out the board, announced what the various tariffs would be for each country, and panic ensued shortly thereafter. Yeah, interesting enough, when the board first came out, and the first words that came out of the president's mouth were, we're going to have a reciprocal 10% base level tariff in most cases, the stock market actually started performing solidly. It was when we started going country by country and seeing the higher tariff levels where the market really unraveled and things went down from there. On the flip side, as I noted, to kick things off, fast forward a couple weeks, couple months, the market rebounded soundly as it was viewed that this was more of a negotiation starting point rather than where we were going to land. And lo and behold, we ended up with a very strong quarter as we outlined. And some of those historic down days early in the quarter were followed by historic up days afterwards. And so this was an instance where proactively having a good strategy and well-balanced portfolio resulted in a very solid quarter and a mechanism to handle that volatility, where if you were looking at the day-to-day moves, it was dizzying and would result in a lot of panic. And of course, it was uncomfortable for everyone, but still good to see the market recover in the subsequent days and weeks. In terms of tariffs, that's been the word on everyone's mind this past year. And it's important to look at the progress that we're seeing with that. So as demonstrated here, as we look at this various chart, you can see we've made trade agreements with a number of countries. So that's what's represented with the blue there. And so you could see some of the primary trading partners, including Japan, the UK, European Union. As of the end of July, we had deals with. The green is the portion with the in-progress deals happening between Mexico and Canada. So still at a bit of a standstill, and we have specific goods that's being negotiated for. China, we continue to be on a pause, still a very high tariff level, but not the elevated level at one point that we saw earlier. And then we have the rest of the world there. And so as you can see, those key partners represent about 75% of trade relationships. And so those are the key points to watch as we drive into this. In terms of tariffs, one key item to note is that while we saw the market recover from that initial scare, and we've reached deals with a number of countries. The average tariff rate that we've seen so far has been well above that 10% initially expected, sitting at around 15%. And the jury's out in terms of what this means for the economy. So far, the economy's holding up okay. Unemployment remains low. We're starting to see some areas slow down a bit. Second quarter earnings were strong, mostly led by the big technology companies. But we are starting to see some signs of slowing. But the reality is, nobody knows after 1 year, 3 years, 5 years into these tariff deals what the impact will be. In a sense, the tariff's really an additional tax, right? Rather than being a direct income tax on taxpayers, it's an indirect tax, through these trading agreements, which are going to be borne either by the trade partner country, the company, that if they're going to eat part of that tariff tax, or if it's going to be passed on to consumers. But at the end of the day, it does serve as another tax. It's been a good income generator where it looks like we could be looking at 300 billion in the neighborhood of revenues for the US per year. But nonetheless, we'll see what the long impact is for the economy. So this is one where so far things are hanging in there okay. But at the same token, we're at a much higher level, a tariff level that initially, may be closer to what that board showed that resulted in all the strain in the markets earlier in the year. But as we've had sentiment go more positive and the economy's held on okay, the stock market's been performing solidly so far. But time will tell, right? A 15% base tariff is night and day from where we've been in past years. So it'll be an interesting key point to watch in the years ahead. Tied with inflation, the next word that most commonly comes out of, most the media, the market watchers' mouths is inflation. And inflation is really at the core of a lot of the policy that we're seeing, both from the government as well as the Federal Reserve and the central banks, as that drives a lot of what the options are and tools available. As we look at inflation, while it's come down significantly from the highs back in 2022, when inflation levels were scraping near 10%, the highest we've seen since the 1980s, it's come down, but we have seen a stubborn level where it's been hanging in that high twos, even low 3% range, while a 2.7% inflation level overall, which is where we sat in July, is much more digestible than 9%. It still is above the Fed target of 2%. And so this is going to be a key area, especially as after seeing it go down dramatically, it started to level off and even increase in some areas, since earlier this spring. This is a key item to watch. It is going to drive much of the decisions around interest rates specifically in terms of what we're able to see. And so when you talk interest rate, Fed fund rate, where do things land? Inflation is really the underlying driver that's going to determine many of those factors. So the sister to inflation is interest rates, as I just alluded to. And so likewise, this is another key item to watch. After seeing some cuts, prior back in 2024 to the current 4.25, 4.5% Fed fund rate, short-term interest rate level, so far this year, we've seen no further cuts. It's been holding at this point. There's been a lot of pressure from the president to the Fed to lower interest rates to keep the economy humming. The current expectation is that we will see potentially a quarter interest rate cut in September. So far, the Fed has been holding off on that, citing unknowns of tariffs and stubborn inflation. That's been persisting for that reasoning. Though the markets do anticipate we're going to see that cut coming up soon. With that in mind, a 0.25% cut we don't think is going to be a massive needle mover one way or another. Going from 4.25, 4.5 to 4 to 4.25. Again, in the scheme of things, will lower borrowing costs a bit potentially, but not going to be a dramatic drop. What we really want to keep an eye on is as Fed Chairman Powell's term is up in 2026, who will he be replaced with? Almost seems like a sure thing at this point that Powell is going to be out based on much of the back and forth between him and Trump. And so what will be interesting is if the next elected Fed chair takes more of an aggressive approach to cutting the Fed funds rate. And rather than dropping it from 4.5 to 4 to 4.25, if we see it drop to 3%, 2%, that can be dramatic. And it'll be interesting to watch what the economy does, but also what inflation does if we run in that type of scenario. After a lot of the, well covered back and forth and dialogue and discontent between Trump and Fed Chairman Powell, did a little bit of digging to see, is this standard? Is this more of a Trump thing versus a president Fed chair thing in terms of a very vocal disagreement between the two? Looking back, there's a lot of precedent for presidents pushing hard on their central bank chiefs to look to lower interest rates to improve the economy, especially with the more shorter term voting cycles that we see for presidents and other elected officials. One, well-known scenario that had a lot of attention at the time was going back to 1965. President Lyndon Johnson and Fed Chairman Martin at the time, a lot of pressure from Johnson to Martin to be lowering Fed fund rates. And it was actually Johnson berating the Fed chairman at that time, including potentially allegedly shoving him against a brick wall to really put the point across. The Fed chairman Martin kept rates steady for a time. He held his own, maybe to keep his public face, but ultimately he did end up cutting rates. And so generally, history has shown that the president has been able to win that battle, especially in this case where Powell's coming up here next year, and the president will likely elect a new Fed chairman. So may see a cut in September. Probably nothing too substantial, but the thing to watch will be if we see a dramatic cut next year and what the second order of impacts are to both the economy and inflation in that regard. So something we'll definitely be keeping an eye on into 2026. So as we look at Fed rates, again, that drives short-term interest rates. That brings a lot of question in terms of what does that do to bond yields? And bond yields are two ways to think about that. One, for bond investors, how much you're earning on those bond investments. The other is for borrowers, how much it costs to borrow. And, kind of from our view, we're going to be really tuned in, especially as we start seeing Fed rate cuts potentially, to see what the bond yields do. While the Fed can control short-term bonds, it can't control intermediate to long-term bonds, which for that matter tend to drive more company borrowing rates, as well as individual borrowing rates such as mortgages. For example, the 10-year Treasury yield tends to be the indicator to watch that directionally dictates where mortgage rates go. Recently, we've seen the 10-year yield dipping down really slightly. As a result, mortgage rates have come down slightly. But it's not necessarily a foregone conclusion that with the Fed cutting rates, we're going to see big drops in mortgage rates, for example, or 10-year Treasury yields. Because at the end of the day, it's a supply-demand game, right? As the government has to continue to borrow more money to pay its debts. This year alone, the U.S. government has to roll in the neighborhood of $10 trillion of loans. That means they have about $10 trillion, give or take, of loans coming due that they need to find new borrowers for to reissue those. And so if there's not enough buyers looking to loan that money to the government, basically buy treasury bonds, that can drive a supply-demand relationship where we could see interest rates on longer term bonds hold where they are or even go up based on that mismatch there and having to entice more buyers with a higher yield. So this will be really one to watch. As you can see on this chart, as of the midpoint of this year, intermediate long-term bonds continue to hold in that 4 to 5% range, which, by the way, is pretty normal historically and still a very reasonably attractive lending rate, especially for intermediate term bonds. So it'll be interesting to see how this trends over time based on Fed funds rate, inflation levels, all those various indicators. So one that we're definitely keeping an eye on. I wanted to highlight quickly, as there's an expectation that the Fed's going to cut rates. We saw some rate cuts last year. We've seen CD rates and bank money market rates start to detract a bit and trace back down. And as you can see, most bank money markets, bank savings, CDs, aren't offering the most attractive yields. Short-term treasury bills, for example, that we can buy, in your individual accounts are still yielding over 4%. And we're seeing quality short-term bonds, such as corporate bonds, investment grade, many of those still yielding 5%. So there are still attractive return options in that department, while keeping in a more conservative allocation there for your safe money is kind of a way that we like to think about it. So make sure, of course, you always want money in your checking account just for operational purposes, but for any excess balances, still want to be looking to earn, in excess of 4% on that amount. So if you feel like you're not getting that, or your checking or savings accounts aren't paying what they should be and have bloated a bit, definitely suggest, chatting with us, with your advisor here, to see if we could find a better solution. So as I kicked off the presentation, it has been a turbulent year. It's been a turbulent 5 years going all the way back to COVID. And that likely is going to continue to just be the world that we're in, given all the different moving parts, uncertainties, various headlines. And when you look at this on a month to month or micro zoomed in basis, it is dizzying, is probably an understatement. So the dark blue line that shows the real up and down, it kind of looks like an EKG almost, right? That is a month-to-month performance of the S&P 500 stock market. And when you look at that, it looks like a lot of volatility and you're not moving anywhere fast, right? When you take a step back and look at the shaded teal, green, blue area that shows a nice upward trajectory over the last decade, that is the total performance of the stock market over that period, where it performed very strongly over this past 10-year stretch. And so it's the same way we think about it. We've had a number of clients we met with recently that say, hey, I'm not logging in online that often. I'm not looking at this. I'll look at my statements each quarter. We'll check in as we do our regular meetings. But I am not looking at my accounts every day. And if you do look at your accounts every day, you're seeing that more up and down jagged line, right? That could create a lot of anxiety, that EKG effect, like I noted. When you look at more of the, quarterly, annually base, that path gets a lot smoother, because again, your investments in the stock market are long-term investments. It doesn't matter what it does in the next day, week, month, year for that matter. It's when we need that money over longer term periods, 5, 7, 10 plus years, that really is what we're being keen and focusing on. And so this is a nice illustration of that. And so for anyone that's feeling anxiety in the market, one, talk to us, let's chat through it. But two, thinking about how you view your stock market investments as more long term, and possibly even, tying how often you look at those to that more longer term basis, can lower the blood pressure a bit. So I thought this was an important and pretty eye-opening chart to see, because based on those two different viewpoints, feels like a much different experience, even though it's been a wonderfully strong 10-year stock market stretch. In general, we've had a really great market this quarter, and a great market this year, and a strong market the last 3 years, and last 5 years, and last 10 years. And so as a result, it tends to get the feeling that, hey, the stock market keeps going up. We're going to see dips like we've seen that comes back in really quick order. And I do want to make sure we're putting across that complacency can be a little bit, not the best mindset at times, right? It could kind of lull you to sleep. While we've had strong stock markets and strong momentum, and I do think the AI trend's exciting, right? The same way the internet was back in the 90s and to 2000s, which has been a life-changing technology, right? And really set the foundation for AI. At the end of the day, the stock market is still about owning companies, owning good companies, and benefiting from the underlying profits on those. And one of the key points to that is, how much are we paying for the company? What's the price entry point that we're entering at? And what's the underlying profits, yield, earnings that we're getting for what we're paying for it? And so when we look forward at longer term, for example, 10-year indicators, generally the best indicator of future performance is how expensive the stock market is. And that's basically that price to earnings ratio, which is a ratio of stock price for the underlying profits. And so I do want to level set, as excited as we are about AI, I think there's a lot of indicators going on, the amount of liquidity out there that could be positive for the market over the long term. We are in very high expensive levels, really the top decile historically. And so, as seen on this chart, as we've shown before, going back to 1991, and looking at the 10-year forward performance for each of those data points, going back, the last 35 years, right? You can see that when the stock market is at the current expensive level, the orange dot there, the next 10-year performance looking forward has not been as rosy. On average, the stock market's done next to nothing the next 10 years at that high expensive price point. And when you look at the underlying gray dots, the range to outcomes, again, even the better 10-year periods at this price point tend to be below average. And so, a couple of ways to think about this. One, you could always think of why this time's different, right? The S&P 500, the stock market, has a higher composition of technology stocks, right? Which tend to be more growth oriented and maybe are worthy of those more expensive valuations. There's a view that AI could be, a game changer, right? And really lift the market. That's a possibility. But at the end of the day, this price to earnings ratio, what you're paying for your stocks, is really the most tried and true indicator of kind of a range of expected returns we can anticipate. And so, with that in mind, we do think it's a proceed with caution scenario. Yes, we expect the stock market to likely get the job done over the long term, but there's a lot of risk at this level. And so balance is key, right? Have the right amount of balance. In addition to US stocks, it's important to own global, in our view, have dividend paying stocks, have the right amount of bonds in there. We're a fan of real assets as a diversifier. And this is a good example, right? Because that way, in the event we do go through a less rosy, more sluggish performance period in the S&P 500, you have other, aspects to your portfolio that can very well do better during that stretch. So again, we've been, bringing up this chart for a number of years, really the last 5 or 6 years, which have been great market years. And so, you don't want to put, this isn't saying that you should make any dramatic shifts. It's just saying that balance is key. And at the same time, where there's a lot of positive things going on, there's a lot of concerns out there too. And, we're entering at more escalated market levels. I will say back in April, we showed a view of this chart after the stock market dropped dramatically. And as a result, we were at more attractive entry points. And lo and behold, from that point, we've seen good stock market returns. So as we do see temporary corrections, which happen every year, that does tend to create opportunities that could be buying opportunities also. And so that's something in our meetings and touch bases, we'll continue to provide thoughts on where we are on things. And based on your personal circumstance, where there's opportunities to try to maximize for that environment. So to sum it all up, when we look at key takeaways, S&P 500 has fully recovered from correction territory earlier this year from that tariff scare very quickly and has once again set new highs. While US inflation has leveled out in the high 2s, low 3% range, it's been a bit stubborn and we haven't been able to break below that level. So it's still higher than the Fed's target. And as a result, the Fed fund rate has stayed in that 4.25% to 4.5% range. The markets are expecting a cut in September. Likely won't be anything to write home about, maybe a 0.25% cut. But we're going to watch closely next year as we likely have a new Fed chairman if we see something more dramatic, which could, ignite inflation again potentially. Tariffs, so far it's going okay. It's been a good revenue generator without increasing income taxes, which has been positive. But at the same time, it's going to take some time to see what the long-term impact is. And we still don't have deals of China, right? Which is our biggest, one of our biggest trade partners, along with Mexico and Canada. So those are ones to keep an eye on. I think probably it's an experiment that can work out, but at the same time, we're not going to know for a little while what the long-term effects are. And, I think we're just in a world, there's so much going on, there's so much information, so many changes. Volatility is normal, turbulence is normal, and it's just something we all got to deal with. And having a proactive approach, being invested in the right way, having a sustainable income plan, strategy. That is the key, right? Not reacting to a lot of the volatility that's going to happen. That's where, in our view, you'll get burned. And so we want to focus on what you can control the controllables, and try to avoid inflammatory news, media magnification, because that's going to create a lot of unnecessary anxiety, right? And again, like focusing on that long-term, well-devised plan matched to your situation, custom tailored to your own personal needs, is what gives us total confidence for our clients in weathering these periods. And this is what we're here for, right? I know we do our regular strategy sessions, but yeah, contact us if you ever have any questions. Before we sign off, I do want to highlight the big, beautiful bill act that was passed earlier this summer. So, a couple of the biggest aspects of this bill that impact most folks is a continuation of the current tax laws. So, the current income tax brackets are going to continue. We were all staring down at some big tax increases in 2026 if these tax laws were not extended. And so those were extended and made permanent. I always put permanent in air quotes because the next time we have, government sweep, right, Democratic or Republican, you're able to change the tax laws. So we're going to have different tax laws at some point. But in the meantime, that sunset went away, was made permanent. So we have the same current favorable income tax rates that we currently have. Skipping to the fourth bullet, with that, the federal estate tax exemption was also increased and locked in at 15 million per person, 30 million per couple. And so that was previously set to cut in half, 7 million person, 14 million a couple. Still a lot of headway, but in most cases, folks have a lot of room without worrying about federal estate tax. So that's not going to impact most people, right? Um, Still have state estate taxes, Washington, Oregon, but at the federal level, that was locked in at a high level. So for many, we don't need to worry about that. The higher standard deduction was also made permanent, and we saw a bit of an increase. So for married couples, 31,500 is a standard deduction. So many people aren't going to itemize, especially if you don't have a mortgage or don't do sizable charitable distributions. Um, we will say a lot of the talk around no taxes on Social Security, was a bit of a marketing campaign. What they did instead, so Social Security is still taxable. However, for those over the age 65, between now and through 2028, you get an additional deduction of $6,000 per person if you're within the income phase outs. I think it's about 200,000 of income to be under that. So Social Security is still taxed, but depending on your income level and age, you get an additional deduction. So as we do tax planning for all of our clients that fit that age grouping, that's something that we look at. And this one is a big one. For state and local deduction, that was raised from $10,000 cap to $40,000. So property tax, state income tax, you are now able to deduct over 40,000. And so people that live in states with the state income tax, or if your property taxes are far exceeding that 10,000, this could be really substantial for folks. It's going to go back to $10,000 in 2030. And this one also has an income phase out, but it kicks in at 500,000, so much higher than the Social Security deduction. So overall, the biggest news on this is that a continuation of the current favorable taxes, which is good news, by the way, because otherwise we were looking at significant income tax rates increases for many. For those that are charitably inclined, a couple additional nuances there. So we'll talk through those as we connect with you. But all in all, it basically avoids a big tax increase. Which all in all, we do think is a good thing for our clients and likely the economy. So with that, we appreciate you tuning in. Thank you. We are here for you. Most of you are aware of our Client Ambassador Club. We are here to help people, and we want to help the people that that you care about. And so as part of that, if you introduce us to someone that might benefit from our services that meets with us, or you bring them to one of our educational events, we'll have one coming up here in October. that gets you as part of the ambassador club, and we do a really fun, thank you dinner. It's a fun night out. So if there's anybody that you know of that you think could benefit from meeting with us, any friends, colleagues, um, put us in touch, and you could be part of our client ambassador club. Additionally, for those of you listening in that aren't clients, yeah, go to our website and reach out with us. Take advantage of a no cost consultation. www.stablerwealthmanagement.com. There's a big orange button on the top right that says Let's Talk, and that is a great way to connect with us. Hope you found this video helpful. We will keep the information coming, both videos and virtual meetings, as well as in-person events. And contact us anytime if you have any questions or want to connect. We are here for you. Thank you again for your time. I really appreciate you, and look forward to talking to many of you soon.